Hey everybody, it's Everett Franks with Capital City Financial Partners. I'm an advisor here, and we just wanted to make a quick webinar for you so we can talk about the recent market volatility, uncertainty, and how you should feel, and maybe some key strategies of what you can use to navigate some of this market volatility that we have going on. Some of the things that our clients have been asking is what's even going on in the market, and what does it really mean for our retirement? Well, what it means is that we're experiencing a very normal part of investing, right? Volatility is absolutely a normal situation whenever it comes to investing long term. We want to participate in some of that volatility because it means that we're going to capture all of the upside that comes along with it, right? The long-term growth that we want out of our portfolio comes at the price of this volatility, and some of that is what we're seeing right now. We've got market volatility, we've got inflation pressures, we've got interest rate adjustments and global uncertainty all happening, and it can definitely make you feel very uncertain about what's going on in your life, your portfolio, and your retirement plan. And so today we want to make sure that you feel comfortable with what's going on, and we want to make sure that you have the strategies to navigate all of these things. So today, some of the agenda that we're going to cover is the current state of the market, some historical trends in the market, navigating emotions, some key strategies that you can use, and the importance of using a financial advisor to navigate some of these market events. So if we look back at the current state of the market, what we see is a lot of different tariff pressures, a lot of these interest rate pressures, a lot of this uncertainty, those four pieces that I just mentioned, right? The current state is really more of a transitional bull market where we saw this large dip in 2020 from COVID. We saw a large recovery when the Fed cut interest rates. And then despite the pullback in 2022 that we experienced, we saw the rise of AI, we saw increased investor interest, and we also saw some economic resilience come through for us where we really kept pushing the market higher. And everybody got to enjoy that, again, at the price of that volatility that we experienced, okay? So currently, we really are still in a bull market. We just do have a lot of uncertainty from some of the different policies that are coming into play and some different economic factors that we haven't had to navigate in quite a while. However, whenever I say quite a while, there's been a long history of experiencing some of these things, okay? So tariffs, for instance, is something that we're seeing right now. Tariffs got introduced in the 80s, they got introduced in 2002, they even got introduced during Donald Trump's previous presidency, and every single time we've come out of those on a positive note. Now that's just one specific instance of a different economic factor. Some of the other historical market downturns that we've experienced are the 1987 Black Monday, 9/11, the 2000s tech bubble, the 2008 financial crisis, and then most recently the COVID pandemic. We saw large declines during these times, and every single time, just like the tariffs that I brought up, we made it through. And that's what all of these have in common, and that's why staying invested is very important, and we'll talk about some more reasons in a second. So some of the questions that we hear are, should I pull my money out? Should I wait it out? Did I make a mistake from some random decision that you made? And the answer is maybe. It depends on your financial plan. It depends on the type of goals that you have, your risk tolerance, and all kind of other factors that this is what you talk with an advisor for. This is why we have our capital confidence process. It's why we focus on our 5 pillars of income, investments, taxes, healthcare, estate. All of these components go into a financial plan to make sure that you have the confidence to retire where you feel comfortable experiencing any of these downturns, right? When we create a plan for you, we make sure that some of these downturns are included. We bake in some stress tests. That way we know your plan can survive and only good surprises are coming your way, even during some of these crises, right? Some really important charts that we're going to show here are from some of these historical events that I just discussed. So one of them is 2020, and we saw this large decline from COVID. It bottomed in about March, and what you can see is that although the decline was sharp, the recovery was sharp as well. And so when we bottomed, we recovered within about a 3 to 4 month time span. The other chart here is of 2008, another very memorable market decline. And what you can see is the same chart shape kind of took place where we had a sharp decline and then a sharp recovery. However, it took 3 to 4 years for this one to recover instead of 3 to 4 months. That's what I meant by some of that variability that I was talking about earlier, where we don't know exactly when it's going to recover, but we know we want to participate in it when it does recover. There's a study that was done by Hartford Funds where they looked at the worst and best days of the market at any given 12-month time frame. And the 10 best days of the market usually take place within the 10 worst days of the market. And so it's really important that we don't try to time either one of those. We just want to make sure that we know whenever we see a market downturn that the better days are coming. We don't know exactly when, but they're really important. If we were to miss the 10 best days of the market in any given year, we could potentially reduce our returns by almost half, which is incredible. So the 10 best days is something that we definitely want to make sure we're taking advantage of. And again, we can't really take advantage of those if we missed all of the worst days, because we are not going to time the market perfectly. We don't have a crystal ball and we don't know what's going to happen. Some other things we can talk about besides the S&P 500 or even some individual stock favorites, right? Like Apple, Meta, or Facebook. These stocks have experienced significant growth over the course of time, and they've experienced some significant drawdowns as well. You can see that in these charts too, where there have been large declines, but they've recovered because they were resilient companies within our economy. So it's really important to make sure that we're staying in. Now, when it comes to experiencing these emotions, whenever we see these downturns, it's hard not to feel frustrated, not to feel uncertain, not to feel like there's something you should be doing to make it better. And that's all very valid points. I feel that way myself, even as an advisor, seeing my portfolio go down, my retirement go down, my nest egg be hurt in any kind of way, right? These are all really difficult things to experience. And so these emotions that come up that make you want to have these reactions, we want to make sure that we can work through them. It's not wrong to experience them, but we want to make sure that we can work through them appropriately. So some of the emotions that come up, they can make you try to chase a trend, for instance, whenever you got out of the market early and now you want to jump in because it's at all-time highs, or because the market dropped 20 or 30%, we want to hurry up and jump out and get into cash, even though I just told you that the 10 best days usually will come near the 10 worst days, right? So even knowing that fact, you still might feel like you want to jump out because the pain can sometimes feel like it's a little bit too much. In order to navigate some of these emotions, there's different actions that we can take, right? It's not about what you're feeling. Those are all valid, but we want to make sure that the actions that we take during those are what's important and what are correct. So some of the things we can do is rebalance our portfolio. We'll talk about some strategies at the end of how rebalancing can be a very strategic move. We can adjust our risk exposure, which is kind of hand in hand with rebalancing our portfolio. And we can just shift funds around, right? If there's some level of cash that we want to hold to make us feel more comfortable, maybe we can use that as an opportunity to make ourselves feel more comfortable, guide those emotions away from us in an appropriate way. So this is part of why we make a written plan as well. So the financial planning process, our capital confidence process that we walk everybody through, it's so we do have that set in stone written financial plan where we can know exactly what actions to take. We know what we've planned for, why, and how we're going to get there. So we'll know what each account is for. We want every single dollar to have a purpose behind it so that we can't emotionally react because we didn't know what that dollar was going to be for or what was going to happen to it. We want to know exactly how long that money is going to last. And we also want to know when it's going to be used. And again, we'll talk about some strategies where we can think through this process together. So some of these 4 key strategies that we're going to talk through, the first one is knowing your time horizon. Knowing your time horizon is part of what I mentioned about having a purpose behind each of these, right? So there's a saying where we can't control the weather, but we can control the sales. And that's what knowing your time horizon helps you do, right? And that's also what working with an advisor helps you do, is control those sales to guide your retirement plan to the goal or place that you want to end up at. The first bucket out of our 3 buckets is our 0 to 2 year time frame. This is going to be some of our more liquid cash. This is going to be our money markets, our CDs, our treasuries. These are things that we can access very quickly and we can feel very safe holding a lot of these items. If the market's going down from our long-term bucket, we're seeing a 20, 30% downturn, we know that our bucket number 1 can take care of our living expenses and we don't have to worry about it. So that emotion that we feel, it's okay to feel it. We know we can take care of our living situation. The second bucket is going to be an intermediate term bucket. The first one was 0 to 2 years. This one's going to be 3 to 12 years. This is going to fit items like our dividend paying stocks, our balanced or moderate growth funds, some structured products, some annuities, things that we're not giving up our full upside on. We want some or all level of protection on. We can feel comfortable with it, but we know we're going to be holding it longer than just a year or 2, right? This bucket is our bridge between our bucket number 1 and bucket number 3. So we've got short term, intermediate term, and then the third bucket is our long term bucket. This is going to be our growth bucket, our legacy bucket, future income bucket, things that we really want to make sure outpace inflation, right? This growth bucket, let's say we're experiencing a 20 or 30% downturn, right? This is where maybe we take some money from our intermediate or short-term bucket and we move it into our long-term bucket. We can buy the market at a low because we planned with these other 2 buckets of how to strategically make a move and take advantage of an opportunity that may not feel good. Even if we're feeling pain about it, it still is an opportunity when we see the market down like that. The other thing, and here's where working with an advisor may make some sense, is if we see 20 or 30% downturns, and maybe we can do a Roth conversion with that money instead, right? So we can convert at the market prices while they're down because we're not using it. We have that money set aside for 12 plus years out because it's in our long-term bucket. Whether that makes sense for you or not, it depends. It depends on your situation, depends on your risk tolerance, it depends on your goals, and it depends on what's going on in your life, right? So this is where sitting, talking with an advisor, it makes sense each time something like this occurs, because whether it makes sense at that point depends on your specific situation. So this is the first strategy that you can use. Knowing your time horizon, using the buckets, making sure that every dollar has a purpose behind it is incredibly important to guide yourself through some of these market downturns. The second strategy is staying invested, but staying smart, right? So timing the market is borderline impossible. Even if you are able to time one side of it, which may be getting out early before the downturn, how do you know when to get back in, right? Trying to time something like that, it's, like I said, borderline impossible. So we want to make sure that we're in the market. So not timing the market, but time in the market is what's important. Again, if we look back at our Hartford Fund study, the 10 best days are near the 10 worst days, so time in the market is why that matters. That's where that study proves to you that time in the market is what's going to be more important and a lot less stressful than trying to time the market every single time something happens that scares you, right? The third strategy is going to be to rebalance and reassess regularly. So I just gave you the tool on how to do this. We want to make sure that we schedule regular check-ins with your advisor, with your portfolio, with yourself. We want to make sure that our goals, our risk tolerance, and our timeline are still suitable for the way that we feel and what we're trying to accomplish. Maybe the original plan we put together, maybe things have changed since then. And so maybe we do need to adjust some of these goals, tolerances, and timelines. Maybe the market's experiencing a downturn, and so we do need to make some of those strategic adjustments between all three of your buckets to ensure that you're still achieving your goal, right? So again, we want to look back, we want to use the tools that we've been given, we want to think through things strategically and logically and not react emotionally. The fourth strategy is to make sure that we focus on the things we can control. So I gave you that saying, I said that we can't control the weather, but we can control the sales. Part of your sales is working with an advisor. Part of your sales is having a financial plan. Part of them is having the 3-bucket strategy. The other part of that is making sure that you control the things that you can, which is your withdrawal rate from your portfolio. It's your savings rate from your income. It's the exposure to taxes. It's your investment allocation or risk tolerance, right? These are things that you can actually control. These are your sales to guide yourself to the place where you want to go. And we want to make sure that we're taking advantage of these in a way that suits us best. So all of these strategies come together. They all focus on making the best decisions for you and putting together a capital confidence plan for you so you can have confidence in retirement. The importance of working with a financial advisor and having this plan comes down to a couple of pieces, right? The first component is expertise and strategy. I've given you some of this already. We talked about our bucket approach and we talked about some of the strategies you can use. Some of that is rebalancing. Some of that is trying to think outside the box where we do a Roth conversion with that opportunity instead of a rebalance, right? Those types of things that come up and whether they're suitable for you or not are best to be discussed with an advisor, and they're best to be discussed while we're reviewing a plan that we've already put into place, a plan that took into account all of these downturns, it took into account your situation, and it's focused on getting you to the goals that you want to get to. The second one is another perspective. It's really easy for an advisor to take emotions out of the situation because this is what we do every single day. We've seen the market, we've studied a lot of this, we know exactly what strategies we have at our disposal to take advantage of, and whether they make sense for you, again, depends. But having the second perspective on something where we are not going to react emotionally to whatever is going on in your life or globally or economically is very important to have that outside perspective, that second set of eyes, right? The third component is going to be education. So what happens is that we go through this phase of accumulation. A lot of times we're really just focused on growth. We're 100% in the market very often. And some of that can be a little bit easy. However, when we start experiencing downturns, when we're in our distribution phase, our retirement phase, we start needing to reduce risk. We don't really want to give up all of our upside sometimes. We might need to be introduced to some different investment strategies or investment products that we're just really unfamiliar with. And on top of that, some of the economic and historical trend stuff that we've already discussed, right? Just being able to educate you about some of those things can make you feel a lot more comfortable with what's going on and with what actions you or we are taking together to make sure that your plan works. The fourth component is going to be accountability. It's really easy to put off financial planning, and we keep track of all of the things going on for you, right? We want to make sure that we're regularly meeting up. We want to make sure that we look at your plan every single time that we meet. We want to make sure that nothing in your life has changed significantly, and if it has, how can we make sure that your plan is still going to work to keep you on track to the place that you want to go? That type of accountability is where an advisor really benefits you throughout your entire life, and not just you, but your family, right? We don't just plan for you and your retirement. We make sure that every single goal, including goals for your family and legacy, are included in your financial plan. So today we talked about different historical trends. We talked about some of the uncertainty and volatility going on in the market, and all of this stuff is completely normal. All of the feelings that you're feeling, I'm feeling them too. There's nothing that you can do about some of these except make sure that you're thinking through them and you're not reacting emotionally, like we said. We gave you 4 key strategies where you can use to think logically through some of these events when they occur and to make sure that your plan is still on track. So whether you're in retirement, whether you're working with us, whether you're being introduced to us to the first time, all of these are strategies that you can use, and we want to make sure that you are going in the right direction. So if you're working with us, come in, schedule a mid-year review. That way we can review everything with you and make sure that you're still on track. And if you're new here, we offer a complimentary service where you can come in, we'll review your current financial plan, make sure that it fits you, and make sure there's no changes that need to take place, and just keep you going in the right direction. Again, that's at no cost to you. That's part of our capital confidence process, is walking you through the 5 pillars, 5 steps to get you going in the right direction. So call us, email us today, and schedule a meeting. That's all that I got for you today. Thank you, and I hope you'll have a good rest of your day.